So welcome to our Everything Marketplaces workshop. So this is a live workshop for our members of the Everything Marketplaces group. Today, I'm super excited to welcome on Matheus, who is at Tint, which is a marketplace insurance product, embedded product for marketplaces. So he is definitely one of the most knowledgeable people I know when it comes to marketplace insurance. So I'm super excited to have him lead the workshop with us today. So I do want to mention this is going to be about a 20 to 25-minute presentation. And then after that, we'll open up a group Q&A for those that are on. So if you have any questions, you can just post them in the Zoom chat during the presentation, and then I'll call on you when we get to the group Q&A. So with that said, welcome to the workshop, Matheus. It's great to have you join us here. And I'll let you take it over from here.
Yes, so I do have a presentation, and I'm happy to share with you right now. So, but I'm also happy to keep it more conversational as well, if that makes sense. So whatever works. And I think the advantage is, looks like we are in a small group, so we can definitely I will make sure that I have more time for questions, and then we can get very specific.
Cool. Yeah. So typically what we do is we just do like a brief kind of presentation, and then we'll just kind of call on people that have questions after that. So
great. So let's jump straight on it. Well, the goal of today, as you guys know, is to talk about like insurance for marketplaces. And what I'm gonna try to do here is really set a framework to help you think about through your risks, and then see how insurance fits that. Because I guess maybe the overarching lesson here is that insurance is one of the components of kind of more broader risk management strategy, and how you think about risk management does influence what kind of insurance you need and how you do it. So let's do this. So first, a little bit about me. Some of you already know me, but no, I'm born and raised in Brazil. I went to college there. I started my career as a management strategy consultant in a company called Monitor. Came to the US for business school. After business school, I founded a startup called 3Ps. We're trying to do some group travel and help people organize trips as groups and get discounts. That didn't quite work, so we were working this project for about a year, but it didn't grow and to go where we wanted. And I was lucky enough that like about a month after I ended 3Ps, I joined Turo in 2014, early 2014. At the time, Relay Rides. So I was still a company with about 12 employees when I joined, and I stayed there for about 4 years and saw it going from that to kind of dozens of employees to hundreds. And when I left, there was over 350 employees, and the company was already a kind of highly successful startup. My job was to lead international expansion. So I was the first employee outside and built all the business outside the United States. I moved to Canada, then moved to the UK, and kind of worked on making that happen. And 80% of my time was dedicated to insurance, which I had no idea going in, and I didn't expect that I would spend my time with insurance, but that was basically what the job required, and I loved it. To be honest, like I found, of course, saw how hard it was to get insurance for Turo, even Turo already being a very successful and venture-backed company, but also saw the potential for different kinds of companies to use insurance to grow and to boost their businesses. And then I team up with the guy that used to run data science, Jerome, at Turo, to launch Tint. And that's kind of what we're working on right now. And we help any marketplace or any company embed insurance into their product. So yeah, starting with a brief intro. What makes marketplaces tough when it comes to insurance and risk manager, but insurance specifically, is a kind of three-party transaction. Like insurance, the bulk of insurance was built and thought about, like normally the insurer in one party. So there's a company buy insurance, there's a person buy insurance, and that's pretty much it. When it comes to marketplace, you have to think about three parties plus the insurer. So it actually is a kind of four-party conversation. And that kind of breaks a lot of the insurance kind of logic and rules and legal stuff. And that kind of makes it hard, and so that's one of the key things to think about when it comes to marketplace insurance. And then when it comes to your management of that risk, it's all about risk versus growth, right? Um, if you put too much friction and then you only prioritize risk, you get no growth. So Andre, the CEO of Turo, likes to say that the marketplace with no risk has no customers, right? But obviously, if you go too far on the other side, you're just gonna forget about risk and just do growth. You're probably gonna get in trouble as well. So the first thing you need to figure out as a marketplace is like, based on your business model, based on your stage, like where do you want to sit on that balance, and that kind of would influence your kind of user verification, your insurance strategy, and things like that. And something to know, like, bad things will happen, and there's no way you can avoid that. It's just a matter of thinking, what do you do, how do you react, and successful businesses, deal with hundreds of bad things per day, and but they just learn how to do it, and they just kind of like figure out on the risk strategy how to mitigate the effects of this. Um, and that kind of brings me to, but one of your first, okay, you thought about your risk versus growth, like I'm okay putting those sort of frictions in front because it's important to give credibility, good trust. And I mapped what are my risks, and I understand, like the risk of somebody stealing a car, there's a risk of somebody trashing an apartment, a risk of somebody that goes do a task, breaks a TV. So I understand kind of where are the risks, what are the kind of things I need to do. And then you have to figure it out, what do you do about that, right? Like you can keep them in house and say, you know what, I'm gonna face it, and if somebody breaks a TV, it's gonna be $2,000 out of my pocket, and that's okay. I can survive. So this is an example of like a low probability, low risk perspective, all the way to the other extreme, which is like there's this kind of risks that if that happens, I can go completely out of business, and then like I cannot let that happen. And then in that cases, you shouldn't even do anything of that. Like you should stop anything that could create those kind of risks, and don't have any of that in the marketplace. And then the other two, no, the high impact and low probability. This is typically where you insure. So those are like liability losses, like whatever it is that you're doing can result in a death of a person that creates a multi kind of maybe $1 million loss. Like that is an example of something that you it's very unlikely that happens. There's no way for you to really stop this because this risk comes in every transaction. So that is normally where you buy insurance. And then on the low probability or high probability, low frequency, there's an example of physical damage for car marketplaces, for instance. You can just kind of find ways to reduce and self-insure it as well. And other considerations that you need to think about is like that is go beyond what you're doing only on your products. Like are there legal requirements? So like auto insurance is an example, or any vehicle related marketplace, you need insurance. So you have to get it. There's even if you wanted to do everything in house, you have to do it. And then conversion and gross margin, because something that the carriers typically don't understand very well is that the insurance impacts the conversion of your core business. So they may want to know, like, put high deductibles or high price in front of your customers, and depending on how it works, you won't not only not sell that insurance policy, but you won't sell the transaction. The transaction won't happen. So you have some conversion things to think about. And finally, your gross margin. Like, do you want insurance to be a profit center? Do you want insurance to be a loss center, but you're gonna accept that because you have to do it? So those are all things you need to think about as well. Uh, so let's look at a few risks and try to make it a bit more concrete. So first of all, like, it's not insurance risk, but I just want to like show here is fraud, right? Like, of course, fraud, you have to stop it. You have to use Sift, you have to use Jumio or whatever things you can think about in the market to try to prevent from happening. And typically fraud is self-insured. If somebody stole an ID, did something bad in your marketplace, you're gonna pay for it, and there's no way to kind of insure. Um, then you have that incidentals risk, with typically bad behavior. They are not necessarily insurance loss, but they are kind of detrimental to your marketplace. So people smoking cars, people being late, last minute cancellations, no shows. So those are kind of all example of risk. They are incidentals. Companies typically self-insure them as well, because there's too small and it's just annoyance, and then no insurer will actually take those. And then we start to get on the risk that are typically insured, so property damage, from broken things to stolen things. This can be self-insured or insured. We see that the journey here typically starts with self-insuring when the company doesn't have enough money, and then go all the way to, insuring when the company doesn't have enough money, and go to self-insuring when the company has more data to predict those risks and more money to finance it. And this can become again, go back to, this is a high frequency, low risk, low severity risk. So the good candidate to self-insure, but it needs some capital. And liability is the one that is almost always insured, because it's so rare, but whenever it happens, it's a big loss, and like you don't want to deal with that. Plus, it's typically required by law in some cases, like vehicles to be offered by a proper insurance company anyway. And there's another risk that is bad debt, which is, uh, suppose you have a deductible of $1,000. So you say you sell insurance, and if everything were to happen below $1,000, the customer is on the hook. Um, but what if this customer doesn't pay you back, right? Like, what if they're on the hook for $1,000 and they never show up, they disappear? You end up sucking this loss. This is typically self-insured as well, but you could find ways you're gonna get insurance from this. So this is just a kind of a summary of like a few kind of high pockets of risk, and how you can apply this idea of like, what I want to keep, what I want to self-insure, and then like try to find ways to mitigate that. And because I know you've seen like there are different dials that you can think about, there are very different strategies the marketplaces typically do when it comes to kind of risk management, but insurance more specifically. So the first step is like, you offer some sort of insurance to our marketplaces, you insure, yeah, and you include that in the price. So think about a Uber. Every time you get a Uber as a driver, and even as a passenger, comes with insurance. You'd never see, there's no mention to insurance, but that is already baked on the trip fee, on the marketplace fee. Um, and you don't have to think about it. Now, TaskRabbit, right? Like they have a host guarantee or job guarantee. So if anything goes wrong with a TaskRabbit job, they will pay. So that is, you're already kind of covered for this. So for this model, like what you're trying to do accomplish here is to reduce the losses or reduce the cost or the premium, because this is a cost center to you. Then the next layer is to offer all of some of your insurance stack as an optional product on a website, and start selling and charging it. So think about Turo. It's very common on the vehicle space. Every time you you go rent a car, the liability piece is included on the price, but the physical damage part is sold as an add-on at the checkout. So when you thinking about doing those things, like it's about how do you launch that? Now, how do you actually manage this and manage the capital? Make sure you don't go out of business and things go wrong and you're self-insuring that. But it's a matter of like, how do you price? How do you think about increasing the profitability and the conversion of those products? And finally, there's the last step is you start selling insurance products that ancillary to the experience. And like for instance, Outdoorsy does trip insurance. If there's a or travel insurance, like if there's any problem, you have to cancel this trip, you can do it. You will be on the hook for the full value, but because you purchase this insurance, now you are allowed to cancel that. Or it could be a rider share, or others sometimes have like some accidental protection for owners. If you go into an accident and there's a healthcare bill, we can help you with this. So again, is selling ancillary. And there's no right or wrong here. And those are different stages that a company can go. and it's up to you guys again based on your risk and in your strategy where you wanna sit. But great, that's all cool. There's all those knobs you can put, but like how do you think about those things like in your own context, right? So first, like yes, you're not alone is quite intimidating, and when you think of all the things you have to think about, like it's pretty confusing. And unfortunately, there's no way, like the complexity is there, and there's no way to reduce the complexity. Like you just have to figure out a good way to kind of maybe break this problem in smaller pieces, and or find help to help you kind of make sure of this puzzle. So one framework that I like to use, trying to kind of make this more like a step-by-step process that you can figure it out, is to think it of a roughly like you have your core business, so it's very important to, as I mentioned, to figure out what are your goals as a business and why you're doing insurance in the first place. But then from the insurance part, you can kind of think it as in a four-step process. First, like what are the key questions you should be thinking when designing? Then the second one is like, great, I understand what I want, but what kind of risks I want to accept, what kind of customers transactions I want to accept. Then you can think about, great, for those risks that I accept, how do I price them? How do I charge for them if I'm charging? How do I pay for the insurance if I'm buying for the insurance? And the last piece is like, I understand my risk, but I don't want to deal with any of that. I want to outsource all that to insure. Great. How do I actually do that? So let's start by the first piece, which is the design. Um, I brought here a few questions that you should be asking yourself as going through the insurance process, which is like what the plans you want to offer. Like, do you want to have one insurance that one size fits all? Do you want to offer different tiers and with different prices and stuff? Uh, what do you want to cover? So what is like the main risk that is going through your marketplace that you want to cover, and kind of that will help you sell more? So an example like on car is obvious, the kind of auto insurance while the transaction is happening. But say you were a shipping company, like what is the kind of shipping insurance or the shipping coverage that if I were to offer, that will help improve the conversion of my website because people trust me more, and so forth. Do you want to charge money or do you want to include in the fee? What are deductibles and limits? Like how do you, and we see now limits, it's typical for the sharing economy to be like a 1 million, but 1 million is expensive. Do you need 1 million? Like, do you think your risks will ever get you 1 million? That like, you should promise that your host or everybody else, you pay up to 1 million. Often it's not the case. If you had a 100K limit, you provide the same protection they need, the fraction of the cost. Um, and I think lastly, super important is like, how do you present that to your customers and what part of the user experience? And obviously, like, do you have it at checkout? Do you collect money from it, or is just so you put on the homepage that everything is insured? So, kind of thinking through those things make now they all will influence where your kind of insurance product will land. As an example, Turo has, now they have gotten from almost like a one size fits all insurance when they started to a quite sophisticated program now where varies by state, varies like there are different packages for the host, different packages for the renter. Part of this is self-insured, part of it is it's transfer to insurers. Uh, they have no pricing may vary by age. So it's just an example of saying, like it is a journey. And then we typically recommend you to start small, start simple. And as you get traction, as your risk pool becomes bigger, then you can start making more steps towards some sophisticated um, program. And I mean, Turo is an example of a company that did this journey. I'd say it's not perfect yet, but it certainly works well. On the risk selection, so great. So I kind of understand, but like, what kind of risks should I accept? The reality is that for most of the kind of mid-sized marketplaces, this in a way, or at least the baseline is defined by your insurer. So the insurer is going to tell you things like, I don't insure customers below 25 years old if you are a vehicle space. Uh, so if you're the vehicle space, so the what you can do there is get what is the baseline that the insurer gonna give you in the early days, and see what you want to put on top of that. Like, do you want to be more restrictive? Do you want to be less restrictive? Do you want to do background checks, even if your insurer doesn't ask for background checks because you think that's important for your trust and safety, and things like that. And in the early days, it's all rules based. You're gonna have things like, well, in that case, if the driver is younger than 25, I cannot accept. Or if the person has a one DUI on the driver license, I cannot accept. Or if the person has a criminal or some sort of crime activity, I cannot accept. So those are all rules. But over time, as you grow, as you have more data, you can migrate to doing more kind of fancy things like machine learning, where instead of being a clear rule, you can use a combination of, like, dozens of different factors to risk score those transactions and get to like a better segmentation that is no longer accept reject, is a more like nuanced view where you can do different things for those different kind of risk segments, if you will. The advantage of rules based is easy to understand, easy to implement, and it's easy to kind of get a blueprint from an insurer or from somebody that's done that before. The downside is, like, it's not as great. It's not like doesn't segment your risk pretty well, and they're kind of human biases, like, why do you accept 25 or not, is based on, like, they are 25-year-old drivers, they are very risky. They are 25-year-old drivers, they are less risky, and you kind of miss those kind of nuance. Uh, Whenever you go to machine learning and do more sophisticated things in assessing and selecting your risk, better performance, much more granular, but obviously more complex, requires more data, um, and you're gonna go from human bias to sample bias. So the model you learn, whatever your data has, is gonna become as good as your data is. And if you were not penalizing a certain pool of users, the model is gonna keep doing that as well. So again, for you guys, for most of you, it's not really a choice at this point. You should start with the rules based and make sure that you cover that base before machine learning. But make sure that you're already thinking one step ahead and knowing that you're gonna get there and eventually replace most of the rules by some models that they're better. Then great. So now you know roughly what you want for your insurance. You understand roughly, like, now what are the guidelines of kind of risks you want to accept. And then the next step is, like, how do you actually price those risks, right? So how do you pay for insurance, or and then if you're self-insuring, how do you price? Like, what kind of price do you display to your users? And typically there's a journey here as well, which is starting with a simple price as, like, hey, it's $10 a day for everybody, and then it's either you're gonna pay $10 to your insurer, and you may put a margin, a little bit margin on top, and then you're gonna offer add 11 to your users and make money. Or if you're self-insuring, you're saying, yeah, it's $10 across the board, and you run the math to say, well, if I collect $10 for each transaction, I think I'm gonna lose maybe 5 in claims for on average, so I'm making 5 as a profit. The next stage is to go to by segment, right? And start using things like age, location, the type of asset. If you're in a asset sharing marketplace, in a car example, there are SUVs, sports car. There's a old Honda Civic. They all have very different risks. So we start getting a bit more sophisticated there. If you are in a shipping company, there'll be different shipping routes. There'll be different kinds of products that you ship, and then getting a bit more understanding of what are those factors, and putting a matrix that has a few factors and prices varies based on this matrix, which is how most of the insurance industry works today. you'll be surprised. Most insurance pricing, it's not very sophisticated. They have one base price and a few factors that vary the pricing. And then finally, I think the holy grail is to get to, as you grow as well, is to get to a place where it's the pricing is kind of personalized for that specific rental and took into consideration which are the parties involved, owner, renter, what's kind of the asset, what kind of use, what kind of credit card they're using. Like, it can get very sophisticated on there. But again, typically that's something you deploy later. And I mean, I think it's kind of self-evident, but like the as you go further to to the right, you get better. You get probably the nuance and the granularity allows you to increase profitability and being kind of even like fairer, I would argue, to your customers and make sure that they're paying something that is risk-based and is not just kind of a bland average. But obviously that increases complexity as well. So the average, you don't have to do much. On the other side, you probably need models running in real time. You need ways to show those prices to the customers, calculate those things on the fly. So you need to build product to deliver that as well. And you need scale. You need to have some amount of data that can be used to mine and come up with these insights. Um, and then the last piece, which for you guys, it's kind of from my conversations kind of obvious, right? That yes, I'm looking for insurance. I left that last on purpose just to show that like there are many steps and things that you had already thought about it and you had tried to figure out before you decide if like, yes, I want to find an insurance company that's going to get all of this and I'm not going to touch it. Or, saying, well, I want a part of this to go to insurer, part of this go to stay with us. And then, like the things that you have to think about are basically the things that we already cover, from legal requirements, branding. Do I want to stick a logo of insurance company on my page? Does this help me? And things like that. Um, and then from there, from here, we can do many different combinations, right? From getting one policy from an insurer that gets all the risk to getting one policy from the insurer. So you're still kind of working on the paperwork, but you, let's say, get a high deductible or something like you are on the hook for any loss below $50,000. That's an example where effectively you are still using the insurer, you're still using their claims, you're still paying a premium that is smaller than if you paid if they were taking all the losses, but you are now putting your capital on the hook, hoping that you can run that profitably. Uh, you can do self-insurance via captive. So that's when you create your own version of insurance company where you start selling those products and keeping all those risks yourself. This is very common as companies scale. The Turos, the kind of outdoorses, the Ubers of the world, they're all going to have some shape or form, some captive structure. So again, the journey here typically starts in finding insurer to work with you so you can get started, all the way to get fancy as you become bigger and you have more risk. The pros and cons here are also very kind of straightforward. Retain is cheaper and means that if there's a profitable, because you don't have to pay the margin of the insurer, you can really streamline the process, but it's more sophisticated and you are on the hook. So you need some sort of capital and reserves to make sure that you can survive if things going to go bad. So let's think about an example here. You are a car company self-insuring physical damage. That's great. Most of the time, like after some time, you can really predict, X% of transactions will have a claim that's going to cost me, I don't know, just throw up a number here, $5,000 to fix each of those claims. It's really a math problem, and you can tell, great, on average, I'm losing X, I'm going to charge you Y, life is good. But what happens if there's a flood in San Francisco and suddenly, 25 of your cars get completely destroyed by an earthquake, and maybe a good bad is NSF get destroyed by this at the same time, right? Then maybe it's only 5,000 per car, but what if you get hit 100 times in the same month? Or those are the considerations that like that's why you need some sort of capital, and then transfer obviously the opposite, right? You lock your pricing at a higher point most likely, but at least you don't have to worry about it. Uh, you do have to worry in year two, because that's one common mistake that founders make, is to think they're like, great, I have a policy, I'm now not on the hook anymore. Like, yes, you are, because if the insurer gets matched this year, next year they're gonna come with a much higher pricing, and you're gonna effectively pay for all those losses, but kind of a year later. So you're still on the hook, but at least you know that you are somewhat protected by the insurance policies, but it's going to be more expensive. It's going to come with like a higher pricing, and you are paying a broker margin, you're paying an insurer margin to make that happen. Typically the journey starts to transfer and go to the retain part. And then I guess like the last piece that I want to cover before we go to kind of the Q&A session is, because there's a good news for all of this, which is like you guys sitting in a huge trend that's happening in insurance, where there was kind of this brick and mortar agent selling model for hundreds of years, 20 years ago ish, that started to come online, but it's still pretty much the same experience where you have to go to a website, get quotes, buy policies, all this stuff. And now we're going to like a much better phase for customers, which is like what you are seeing on your side, which is like they should get insurance through you as part of the experiences, as part of the brands they already love, contextual, personalized, and they don't have to go in another place. They're getting that through your product, through your service. So that is a huge opportunity. And experts saying hundreds of millions of dollars of premiums will go through this way. So always create an opportunity for you guys. 75% of customers say that insurance is a big part of their decision when buying a product and service. So it is also important to you guys to figure it out this plan. And some kind of last pieces of advice is like invest the time. It is a pain in the ass, we all know. It is confusing, as I mentioned before, but take some time to think through and together with your partners to these considerations, like how I want to do on a charge, or not. Like going through the flow that I mentioned is super important to get a good hypothesis of what you need, and then from there go and find it and execute on it. Insurance will unlock your growth. Like a lot of clients are uncomfortable, especially in a scenario where Airbnb and others set the stage with like it's $1 million protections are standard. So if you don't have it, it's likely that your competitor you have, or clients will ask like, why don't you have, and then maybe feel uncomfortable. So insurance is about growth. People tend to think as a risk and a loss thing, but it's really about growth. And ask for help. There are different kinds of companies and shapes of forms that can definitely help on this process. I'm obviously biased and think that like the best ones are the ones that understand your risk case, understand insurers, and have some sort of tech to help you there. But there are plenty of options, and one option is you trying to call insurers directly if you think that's the right thing to do. Yeah, and that's pretty much it. I think as summarizing again, like take the time. It is a growth opportunity if the cards played well. It is hard, so make sure you get the right help alongside the way. So, any questions?
Well, this is awesome. Thanks for walking us through this. I feel like it's like a masterclass on insurance. So
yeah, and I'll share when you have the video, but I can share the presentation as well. So obviously you can go through the framework and think about it, and I'm happy to help as well. But my experience is, took me a long time to figure it out how to frame, because insurance is, seems too vague, too complicated. But as you start going the peeling the onion, you kind of understand the components. It makes more sense, and that's when you can unlock your growth.
Yeah, awesome, cool. Well, I have a few questions myself, but I'm gonna call on some others first. So, hey, Richard, did you want to come on?
Yeah, I'd love to. Appreciate it. Enjoyed that, Matheus, and thanks for calling on me. Can you say a few words about your company, Tint, how you can help us? And more specifically, I've periodically dabbled over the years with trying to get insurance or liability coverage for our customers on our marketplace. And I think one of the challenges that probably a lot of us on this call have faced is that we're entrepreneurs, we're doing something different, we're doing something disruptive that traditional insurance carriers are maybe not familiar with. So how do you help folks like us who are really doing something new that traditional insurance companies are unfamiliar with?
Yeah, absolutely. So I mean, one pitch Tint to aggressively, because like when I was on your shoes, I would hate vendors coming here and try to sell, but like I'll give you the answers behind on why Tint exists, and then I'll answer your question. So when I was at Turo, I had the same problem, right? Like I'll go to a new country, they never heard of Turo. Most likely it's peer-to-peer car sharing, this kind of very weird and dangerous concept, especially back in 2014 when Uber and Airbnb, nobody was that big yet. So I would say it's hard. One of the main first steps is how do you make the insurer even understand what you do? And then they don't have data, so they're gonna have to make a leap of faith in terms of like accepting your risk and kind of putting some hypothesis based on what the things that they know. So I'd say first step is helping the insurer understand what you guys do. And I think one of the problems we think in the market today is typical standard brokers or legacy brokers. They have a call with you for half an hour. They go on a website and they go talk with insurers. They don't understand what you do. They don't understand how you verify customer. They don't understand where you're going. And then that translates into insurer. And then the insurer will not get super comfortable not fully knowing what's coming out on the other side. So something we do is that, we, first of all, we have the technology platform and the data. So we think a lot of those answers are already in the data. So leveraging the data as much as possible and sharing that with the insurer so they can understand your risk and is the first step. But we typically put founders that work with us to talk with the insurer directly. Like, we see our role to be the conduit between clients and insurers, not a wall that is going to kind of play on the arbitrage of information and stuff. And you'll be surprised by how something that sounds so simple as this already helps a lot, because the insurer is going from, I have very little information from this broker that's trying to withhold as much as possible from me, to I met the founder, I understand the business, I kind of understand the kind of risks they're trying to do, the type of shipments they're trying to do, what they're trying to accomplish. So that's step number one. And then step number two is as you use the technology, as you have scores, there are other things that we can do with technology to help you understand, manage, reduce your losses. That will translate into better premiums on the other side. And finally, as you scale, you're going to bring a lot of those kind of stuff in house. So you want to build your own risk models. You want to understand how, if I increase the pricing of the insurance by 10%, what happens in my conversion? So I think the last piece I'd say is how to empower your team. Whenever you have a team that is dedicated to this, that will come over time to do their job better. And you put all of this together, you can help companies from, I'm small, I'm starting today, I just want insurance and that's all I care about, all the way to, I'm Turo, I have a team of data scientists, I have a risk team, and I want to give them the tools to kind of do a lot of what the insurers do, but in-house.
Got it. Thanks, Matheus. And so Tint is really, you help. You're this intermediary between the founders and our team, and the folks who could insure us, but maybe that's locked up because we don't speak quite the same language. Maybe we don't pitch as well. You have that experience, and we go, us through you and Tint, and you're able, based on your experience in the industry, you're able to, articulate that to the insurance companies. Okay, good. Thank you so much for explaining that.
I'd say is that plus the technology, right? And making sure that you, the guys, don't have to build any of this kind of insurance stuff on your product. You can focus on engineering resources and building, getting your search better, getting your like approval rates better. All those kind of things are already hard enough on the marketplace. And now what the tech does is like you pretty much like abstract all of this to us, to our APIs. So this combination of that plus the brokerage or the connection with the different insurers is what kind of make us different from traditional brokers out there.
And if I could just ask one more quick question, there's traditional insurance, and you go through these carriers, but is there anything to stop a startup from just creating? Are there any regulations that would stop us from just creating our own? Instead of calling it insurance, just, protection program, and say, hey, you showed that slide, and, it's probably quite algorithmic, how many transactions do you have, how many things get damaged or whatever it may be, and you can calculate the risk. And, we could do that ourselves essentially and say, okay, if we give customers, charge an extra $15 per transaction optional, then we calculate that we'll at least break even or make a profit if we offer a $10,000 protection plan or something like that.
Yeah.
Is there anything stopping us from doing that regulatory wise?
So I think you definitely talk to your lawyer and kind of get a proper opinion on this. I'm not a lawyer and I don't give legal advice, but what we're seeing in the market is you're absolutely right. Like companies can, and in many cases should do that because for especially the losses that are not that high, that is something were to go wrong is like $1,000, $2,000. And they happen frequent enough that you can, as a marketplace, get the data to understand that. That is not required by law, right? Like to have a proper insurance policy. That's a great candidate for something like this. And that's what typically, the damage waiver of car marketplaces can fall into this category where it's not really insurance, so it's not regulated as one, but it does provide some kind of protection to clients. And what our platform does there, like we definitely help you understand this, figuring out how much you should charge and things like how much is the deductible limits and things like that. But after you figure that out, how do you put that on your product? Like every time a new client comes in real time, you have to show them something so they can purchase. Then there's a lot of kind of product work required behind the scenes for this to happen as well. And like a platform like Tint does this for you. Just get the answer via API and plug in your front end.
Got it. Makes sense. Good. Thanks. Well, I'm looking forward to our follow-up call, Matheus.
Same here.
Awesome. Thanks, Richard. Cool. Hey, Pierre, did you want to jump on?
Yeah. I have a couple of questions. The first one was more related around the claims and claims management, because that's kind of the scary part afterwards. Like once you've set up that beautiful insurance program and you start scaling, then that's when trouble starts, happening. So I know there's some companies that, and we have discussed with one for ride, that are happy to take on the process for a fee per month. I've seen big competitors like Turo or Get Around have their own team. What's kind of your recommendation to get started? Because to me, it feels that it's really not something, the core business and something that's just going to take time. But at the same time, I want, quality claim center. So if there's any issue, the owner or the renter are happy about what happened. So what's your recommendation when you get started to set that up? I don't even know if like Tint.ai provides like some claim, services. So anyway, I'd like to have your point on this.
Yeah, absolutely. So for the claims part, is again, there's also different routes you can take. And I say there are three routes. One is you do in-house, which to your point, it's not great, and you end up with a, or again, trade-off, right? You control the quality, so that part's great. You control the experience, but obviously, like you end up with a claim center with hundreds of employees managing claim somewhere in the United States whenever you scale, and with all the complexities of doing this. Then the other one is like depending on who is your insurer, they will do it, and they would even require them to do it. So companies like Hartford or the larger, and then they have their own claims team. They want to do that, and they even pitch that as a value prop for you. And then the third one is like you hire what's called a third-party administration, a TPA, that a company specializes in managed claim. They charge you a fee per claim that they manage. It can be expensive, like $500 per claim type of price tags, and can get lower the volume, but especially in the early days, is not cheap. And they will do everything. They have all the legal things, because the thing about claims is that they are legal requirements. The claims is regulated as any other kind of part of insurance. So if you just start adjusting claims tomorrow, you are in trouble most likely. So you obviously shouldn't do that. So then the way of thinking about it, especially from you as small companies, probably or almost definitely outsource in the early days, either to the insurer themselves and having that as part of your insurance package, or find a TPA partner. We don't do that ourselves, but we know pretty well TPAs in this kind of marketplace sharing space. So we're happy to recommend a few partners that could work.
And if I have time for one more, you mentioned earlier, like, I mean, I guess in my domain, I would try to look at the insurance as a profit center, basically trying to bundle it with all the rentals and selling insurance to people who don't need it, because I bet them are okay. But you also mentioned that some companies use this as a loss center. I mean, it's considered a loss center. Do you have a few examples of and some reason why a company would do that?
Yeah, so think about Airbnb or Uber. Let's think about those shoes. Like, they don't charge for insurance, right? They have a trip fee. Insurance is hidden somewhere, so they pay a lot of money. And those are public companies with public data. So if you go analyze the Airbnb, Uber has insurance kind of losses or premiums on the kind of billions of dollars. Airbnb has on the hundreds of millions of dollars. So which means that for every Airbnb transaction, they are losing X dollars for insurance premiums. They can't do that in-house. Obviously, they have a scale to do this, but like by not charging and it's still including on the experience, you are effectively incurring a cost. Like your example, your world of cars, it's very easy to charge, and I think I would argue that car rentals charge is it's commonplace, but places like TaskRabbit, I think it's a bit harder to just say by the way, great, your task is completed, but if you pay $10, I guarantee that nothing goes wrong. They're like, oh, wait a second, like I'm assuming you're covering me already. So it depends a bit on the use case.
Cool, thank you.
Awesome. Cool, that's a good question. Hiba, did you want to come on?
Yes, for sure. So Matthias, I have a quick question for you. So can you explain a little bit about the revenue model? Because based on my understanding, it is basically a revenue share kind of a thing, right? Or am I understanding something wrong? Because when I run a fashion marketplace where we sell some of the products are expensive, in the like of exotic leather, and some are gold. So I was really curious to understand how this insurance will fit into this, play from the customer side and then from the supplier side, because we also be looking to onboard some of the factories later. So I want to understand how things will work. Is it a subscription? Are we buying the insurance? Are we just taking a commission? You guys are taking a commission-based insurance because this is how it works for finance embedded solutions.
Yeah.
So,
Yep.
so can you? Yeah.
That is a great question. And again, guys, I'm hoping, what I'm hoping to achieve here is that you're gonna be a little bit frustrated that there's never a straight answer, but in this process, you understand that there are also like different things that we can do. So the answer is in this case is also depends, because there's a three main monetization models you can think about. One is like a lead generation fee, where you put a link on your website and you just say, you want to buy insurance for like clothes, or do you want to insure that dress? Click here, and then I'll go to some website, and then you're gonna get compensation per click. So that's kind of the Google model, right? Like you are just compensating people for sending, or getting compensated for sending people to their website, and they're gonna transact there. Like I think this is a pretty bad experience, because that's really not embedded. That's like sending traffic, and I think there's not a great model. There's nothing new about that. Then the second one, you could be then in the second one is like you can actually sell the insurance on your website. And that point, and again, I have to talk to your lawyers, understand better your use case stuff, but like it's likely that you would be an insurance agent at this point. And then as an insurance agent, you can get a commission from if you're like selling, and if it like is an optional, is a clear insurance product, you probably need to be an agent and get some, and you can get a commission from that. So you're gonna go to the insurer and say, for every day or for every clothes, it's gonna cost, like we're gonna sell insurance for $10. I'm gonna keep a 15, 20% or whatever is the commission of that. The rest goes to the insurer, the risk goes to the insurer. And then there's a third model where you are self-insuring it. So effectively, you're gonna think a bit what Richard was mentioning. You're gonna like collect the $10 yourself, and then you're gonna pay some of that in issues whenever they happen, and hopefully the math makes sense. So you are on the hook not only for, or you're on the hook for the profitability, but then the goal here is that you can get more than 15%, right? You can get, if you do it well, 20, 30%, 50% of the total premium that you do. So again, depends on a bit on use case, but there are different options you can use.
Okay, clear. Interesting.
Thanks for the question. So I think we have time for one more. So Carlos, did you want to come on?
Sure, yeah, great. I know we have 5 minutes left, but really quick, thanks for all this information. This has been really insightful. So I run a marketplace to help people find and book athletic space. So a lot of people on the demand side are gyms, athletic facilities, and one of our customer base on the supply side who would typically rent some of these gyms would be personal trainers. Or so what we've been doing right now is, in order to, like the insurance piece, we've been kind of pushing it to like the personal trainers, because typically they have like their own general liability policies in place.
Yeah.
So I just want to curious about your thoughts in terms of like that model, because the majority of them, in some cases, they don't have that, or maybe we can refer them to outside partners. But what is your thoughts on just kind of deferring right now to people who already have that existing general liability policy?
Yeah, so I think your use case is very common, because there's basically say two groups. One is like insurance is legally required, cars, for instance. Like you have to do it the early days, you gotta pay a lot of money. It's the only way. So those companies are dealing with this from before they launch. And there is a second one, which I think is what you're describing here, which is not a legal requirement. So you can get started, you can get the initial traction, and you can defer that to other kinds of like insurance policies that will be in place, which is great because you can get started much faster with a lower bar. And then you will start thinking about insurance like as a way to increase your conversion, to increase the value that you provide to your customers. And then the question that I return back to you is like, I mean, you could definitely think about having this insurance as a part of your embedded in your product, and advertise, say, by the way, personal trainers and customers, like we come with this kind of X dollars or insurance policy built in, so don't have to worry if anything goes wrong. Then you can design that, as a secondary to the trainer's policy. So you can even do it in a cheap way. The first goes after the trainer policy. If the trainer policy doesn't have one, then go after yours. But the key question is, do you think that by doing this, your conversion is going to increase? Like, do you have today a supply problem where your trainers are saying, like, I love the idea, but I'm not going to go through without insurance? And if the answer is yes, absolutely do it. If not, then you have to think about it more.
Yeah, I think we're getting that on the supply side, where it's easier to onboard them if we kind of say that to the gyms, to the owners, we have that insurance coverage. So okay, thank you.
No worries.
Cool. Well, that kind of wraps it up. We're out of time here, but man, this is incredibly informative and insightful. So thanks again for taking the time to join us, Matheus. And is there anything you kind of wanted to wrap it up with?
No, thank you first. Thank you for organizing. I think it's great. Yeah, so feel free to reach out with any questions. I mean, I'm on the Everything Marketplaces group as well. Some of you already have my direct contact, but like I'm happy to brainstorm ideas, share anything you want. My goal here is to show you that there is no black and white. There are many kind of shades of gray that you need to figure out to do your product. So look for help. Obviously, we are super well equipped to help you figure that out and executing on this. So yeah, feel free to reach out, and then be happy to help with more. We have a few clients already on the marketplace space. Some of them large, like outdoorsy, and plus our Turo experience. We really understand you and understand your use case. So happy to help whenever we can.
Perfect. You're definitely the go-to. So well, cool. Well, thanks again for joining us, and thanks everyone that joined the workshop today.